The stock market is a complex ecosystem where various players engage in buying and selling shares of publicly traded companies. To navigate this financial landscape effectively, understanding key terminologies is essential. Hi, I'm your host Riya, and today in this video, part 2 of stock market, we will explore and define some of the most crucial terms used in the stock market, enabling investors and enthusiasts to make informed decisions. But before we move forward, make sure you have subscribed to our channel Freedom Money English and download the Freedom app. Well, Freedom app provides you multiple courses in 5 different languages and where you can access the comprehensive stock market course and can learn directly from our mentors at just Rs 399. Let's take a look at the key terminologies in the stock market. Number 1, shares. Owning shares of a company means having partial ownership of that company. For example, if you own share of a company called XYZ Limited, you are a part owner of that company. The share price represents the cost to purchase one share of the company. For instance, if the share price is Rs 100 and there are 1 million shares available, the company's market value is at 10 crore or 100 millions. Number 2, stock market. The stock market is where the shares of publicly listed companies are traded. Companies list their shares on stock exchange like NSE and BSE to raise capital from the public. For example, if a company ABC Limited wants to raise 60 lakh, it can issue shares to the public. The total shares issued will be divided by the face value. For example, Rs 10, resulting in the number of shares available for trading. Third, IPO, or also known as initial public offering. An initial public offering is the process through which a private company goes publicly by selling its shares to the general public for the very first time. This is a crucial event for a company as it allows them to raise significant capital and gives early investors the opportunity to cash out. This process includes creating a draft prospect and submitting it to the SEBI, which is Security and Exchange Board of India, for approval. Once approved, the company can list its shares on the stock market and invite public for the investment. For investors like us, an IPO can be an opportunity to invest in a company from the beginning of its public journey. Number 4, face value. The face value of a share is its nominal value, usually set at the time of issuance. For instance, if the face value of a company's share is Rs 10 and it issues 6 lakh shares, the company's equity capital is 60 lakh rupee. Next is dividend. A dividend is a portion of company's earning distributed to the shareholders. For instance, if a company declares a 10 rupee dividend per share, the shareholder will receive Rs 10 for each share that they own. Dividends are typically paid quarterly and can be in the form of cash or additional shares. Well, it is important to note that not all companies pay dividend. Many prefer to reinvest profits back into the business. For investors, dividends can provide a steady income stream and indicate a company's financial health. Number 6, we have PE ratio. PE ratio is also known as price to earning ratio. The price to earning or PE ratio is a value metric used to determine the relative value of company shares. It is calculated by dividing the current market price of a stock by its earning per share. For example, if a company's share price is 100 rupees and its EPS is Rs 10, then the PE ratio is 10. A high PE ratio might indicate that a stock is overvalued or investor expects high growth rates in the future. Conversely, a low PE ratio could suggest that a stock is undervalued or that the company is experiencing difficulties. Let's move to number 7, market capitalization. Market capitalization is the total market value of a company's outstanding share of stocks. It is calculated by multiplying the current share price by the total number of outstanding shares. For example, if a company has 10,000 shares, each priced at 1,000 rupees, then the market capitalization is Rs 1 crore. Companies are typically categorized based on their market cap into small cap, mid cap, and large cap stocks. This metric helps the investors to understand the size of a company relative to others in the market. Next is large cap, mid cap, and small cap. Companies are categorized based on their market capitalization. Large cap companies are among the top 100 by the market cap. Mid cap companies fall between top 101 to 250 companies. And small cap companies are ranked 251 and beyond. Next up is equity. Equity represents the ownership in a company through holding shares. It signifies the shareholders' claim on the company's assets and earnings. You must have come across this term more often, which is called demat account or trading account. A demat account holds shares in electronic form, and a trading account is used for buying and selling shares. Platforms like Paytm Money and Grow offer these services. Next, number 11, we have market order. A market order is an instruction to buy or sell a security immediately at the current market price. If you place a market order to buy 100 shares, it will be executed at the prevailing market price. Next, number 12, we have limit order. A limit order sets the maximum or the minimum price at which you are willing to buy or sell a security. For example, if you set a limit order to buy shares at 90 rupees, the order will only be executed if the share price reaches 90 or lower. Next up, number 13 is stop loss. A stop loss order is used to limit potential losses on a security position. For example, if you set a stop loss order at rupees 80 for a share you bought at 100, the order will trigger a sale if the share price drops to rupees 80. Next is what is bull market. A bull market refers to a period when stock prices are rising or are expected to rise. This term is often used to describe the overall stock market, but can also apply to specific sectors. Bull markets are characterized by investors' optimism, confidence, and expectation of a strong future financial performance. We have talked about the bull market. Now let's talk about the bear market. Bear market, in contrast, is a market when stock prices are falling or are expected to fall. It reflects widespread pessimism and negative investor sentiment. Bear markets can be triggered by economic downturns, geopolitical events, or other factors that diminish investors' confidence. Next, number 16 is blue chip stocks. Blue chip stocks are shares of well-established, financially sound and stable companies with a history of reliable performance. These companies typically have a large market cap and are leaders in the industry. Example includes companies like Apple, Microsoft, and Johnson & Johnson. Blue chip stocks are considered relatively safe investment with steady returns. Next, number 17, we have bid and ask price. The bid price is the highest price a buyer is willing to pay for a stock, while the ask price is the lowest price a seller is willing to accept. The difference between these two prices is called the spread. The bid-ask spread is an indicator of a stock's liquidity. Narrower spreads often suggest a more liquid market. Next up, number 18, we have volume. Volume refers to the number of shares traded during a specific period. High volume indicates strong interest in a stock, while low volume might suggest limited investors' interest. Volume is an important metric for assessing the strength of a price movement. Number 19, portfolio. A portfolio is a collection of investment owned by an individual or an institution. It can include your stocks, bonds, mutual funds, ETFs, which are the exchange trade funds, and other assets. Diversification within a portfolio helps manage risk by spreading investment across various financial instruments and sectors. Next, number 20, we have mutual funds. A mutual fund is an investment vehicle that pools money from many investors to purchase a diversified portfolio of stocks, bonds, and other securities. Mutual funds are managed by professional fund managers and offer investors a way to diversify their holdings without having to select individual securities themselves. Next, we have number 21, ETF, or known as exchange trade fund. An ETF is similar to the mutual fund but trades on stock exchange like the regular stock. ETFs hold a collection of assets such as the stocks or bonds and offer investors a way to diversify their portfolio with the flexibility of trading throughout the day. Next, number 22 is yield. Yield is the income return to an investment, usually expressed as the percentage. For stocks, it is calculated by dividing the annual dividend by the current share price. Yield is a key metric for income-focused investors who prioritizes regular returns over capital gains. Now, what is capital gain? Number 23, capital gains refer to the profit made from selling an asset at a higher price than its purchase price. In the stock market, capital gains are realized when an investor sells shares at a higher price than they originally paid. Conversely, a capital loss occurs when shares are sold at a lower price than bought. Next, at the number 24, we have index. A stock market index is the measure of the performance of a group of stocks representing a particular market or a sector. Example includes the S&P 500, which tracks the 500 of the largest US companies, and the Dow Jones Industrial Average, which includes 30 significant US companies. Indices provide a snapshot of market trends and serve as benchmark for investment performances. Next, number 25, we have short selling. Short selling involves borrowing shares from a stock and selling them with the expectation that the price will fall. The short seller aims to buy back the shares at a lower price, return them to the lender, and pocket the difference. Well, this strategy is risky as losses can be unlimited if the stock price rises instead of falls. Number 26, we have margin trading. Margin trading allows investors to borrow money from a broker to purchase stocks using the purchased stocks as collateral. This amplifies potential gains but also increases potential losses as investors must repay the borrowed amount regardless of the stock's performances. Finally, number 27th, we have 52-week high-low. The highest and lowest prices at which a share has traded over the past 52 weeks. For example, if a share's 52 weeks highs is 1,000 and the lows is 500, the range helps investor understand its price volatility. These are just few of the essential terms you will need to understand to become proficient in the stock market. For a comprehensive guide and more detailed example, download the Freedom app from the App Store or Play Store, which offers extensive courses on stock market investing, mutual funds, and much more. By mastering these terms and concepts, you will be better equipped to navigate the stock market and make informed investment decisions. Well, that's all in today's video. Hope you enjoyed this video. If you like this video, make sure you share it with your friends and family. Do subscribe to our channel, Freedom Money English, and download the Freedom app. This is your host, Riya. We'll see you in the next video. Till then, take care. Bye-bye.